Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. We have a deal. The U.S. and China shake hands, lowering tariffs for a 90-day pause.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels.
And the ensuing rush to risk. Stocks jump, the dollar jumps, treasuries and gold tumble. But drug makers take a hit after President Trump readies an executive order to cut drug prices in the U.S. We witnessed a major de-escalation in the very early hours of this morning. Trump had set the expectation at 80% tariffs with China. It falls to 30% for the Chinese side. To the U.S., it goes to 10%. And here's what the markets do. We unwind the Sell America trade. You can see NASDAQ outperforms up more than 3.5%. Your S&P 500 future session at 2.7%. All of these indices now trading well above the April 2nd Liberation Day level. We're now back to the highs around March. Still down for the year, I should point out. The dollar also experiences relief. Remember, this is an asset that had been hurt with the higher tariffs, with the policy uncertainty. It is now the worst day for the euro at this pace so far this year. We are also selling bonds this morning, moving into risk assets. You see yields higher across the curve. The pain, though, concentrated on the front end, higher by 9 basis points. We are just below that 4% level, only pricing in now 60 basis points of cuts from the Fed. Remember, at one point this year, that was at 125. So we have walked down a lot from that level. Your 10-year yield at 4.43 this morning. A lot going on markets. Let's look at some of the individual names. Here with that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So one area of the market we are seeing weakness is in pharmaceuticals, as Trump reckons he can rein in drug prices in the US, potentially using a system that looks to use the cheapest prices available abroad. And we are seeing weakness in Novo Nordisk ADRs, also Pfizer, Bristol Myers, Merck, all of those stocks slipping in the pre-market today. Then in terms of the sectors moving on the trade headlines, airlines really standing out for me, seeing decent moves in those stocks. Delta, United, American, all moving higher on potentially a boost from those trade negotiation headlines we got earlier today from Scott Besson this morning. Then finally a quick look at the Mag 7, broad moves higher. The Nasdaq on track for its biggest gain in around a month. Again, these trade headlines really making our job a little bit easier this morning. As usual, keep an eye on the Before the Bell opening wrap, available on the terminal shortly. Danny.
Maybe our job easier, but you got to feel for the sell-side analysts who now need to quickly revise any notes that they had drafted over the weekend. Joe, thank you so much for that. Bloomberg's Joe Easton there. Coming up this hour, a great hour. Seema Shah of Principal Asset Management will be sitting down with us alongside Amanda Lynam of BlackRock. But back to our top story, dominating this morning, substantial progress in U.S.-China trade talks, now a 90-day pause to the eye-watering tariff rates that each nation had opposed on the other.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%.
China also touted the progress made in talks that they described as candid and constructive.
The two sides held in-depth exchanges on trade and economic issues of their respective concern. The atmosphere of the meeting was candid, in-depth and constructive. The meeting achieved substantial progress.
The new rates under this agreement, 30% U.S. tariffs on Chinese imports and a 10% tariff on U.S. imports coming from China. Planned sectoral tariff rates are ineffective. Team coverage on this starts now. Joining us is Bloomberg's Brendan Murray, who leads our global trade coverage, and senior editor Alan Wan in Shanghai. Brendan, let me start with you. What were the takeaways from this morning?
Yeah, I think the key takeaways are that both sides walked away saying that they thought they had a good negotiation, that they got the result that they wanted. But I think it's the more you dig deep into what's actually been announced, it's going to be hard for people in Washington, especially China hawks in Washington, to say that the U.S. didn't give up a lot here and got little in return. So I think there's going to be we're going to have this 90-day window to negotiate the major differences that still are out there, and that's not a whole lot of time. So we're in for a 3-month period where we don't know the goals of the talks under that 90-day period yet, but it's going to be a continued period of uncertainty, and I think you'll hear from the Chinese side that they feel like they diffused a situation that was damaging both economies.
Alan, let's talk about the Chinese side, because the press conferences, the briefings we got were very different from the U.S. side, quite detailed to the point of talking about where the actual physical talks happened. From the Chinese side, it seemed much more scant on the details, really just reaffirming of what we heard on the statement. What did you make of that?
Well, that's the thing. Like Brady just said, I think that there was a joint statement, a spirit of cooperation, and China didn't want to actually go beyond that. During the Ministry of Foreign Affairs briefing today, there were a lot of questions asked of the spokesman, and they said, well, please refer to the statement. But the overall message is that, it was positive, that both sides agreed to de-escalate. I mean, it's easy to say that, China won. I mean, just because it stuck to its guns, but at the end of the day, Trump still has 30% tariffs on Chinese exports. But definitely, it was something that a lot of investors, markets did not expect today. I mean, there was a lot of damping down expectations ahead of the meeting, as well as Trump last week saying 80% possibly. So I think that overall is positive. And from the Chinese side, by saying little, is actually pleasing investors in many ways. You don't really want two sides to go to separate ways.
No, it is a fair point, Alan. I think you'd be hard-pressed to find someone who thought tariffs would come down to 30% and 10% for China and the U.S. respectively. Brendan, you hinted at this. Could you get more into the details of how difficult exactly the next 90 days will be to reach a deal, and whether it looks like we have a ceiling in for what tariff rates will be?
Yeah, exactly. I mean, one of the key things in that statement was the role of Treasury Secretary Scott Bessent. We already knew he was taking a leading role in negotiations on Capitol Hill and various other Trump administration priorities. But he is now the person at the head of the table, along with USTR Jamieson Greer, negotiating for the U.S. side, and it's clear that he is representing a less hawkish version of a Trump administration official than, say, Howard Lutnick would be. So I think there's going to be a more measured diplomatic approach to these negotiations. Again, we don't know what exactly is on the table, but major trade disagreements take a long time to hammer out. So it will be interesting to see what they can put together in just a 3-month period.
In listening to the press conference, Alan, I jotted down something that Treasury Secretary Scott Bessent talked about, this idea that the U.S. wants to rebalance, but it wants China to rebalance trade the other way. That is, it is overproducing and wants China to move into a consumption economy, saying we could rebalance together. Is this a project that China does want to undergo at the moment, Alan?
I mean, if you told me back in 2018 when they first engaged in the talks during the first trade war, I would say I'm not sure about that. But I think in 2025 is a different story. I think the government realizes that it has to rebalance away from exports and fixed asset investment into domestic consumption. And that's what the government did back in March during the NPC meeting. And it's a win-win for both U.S. and China. I mean, China needs more exports. Needs more imports, buy more imports, in order to rebalance its economy away from exports. But it's also, it understands that, how we got here was because, China's massive trade surpluses, and not just against the U.S., but the rest of the world. So it recognizes the fact that, it no longer can sort of keep this model. So I think that it's a possible, it could be a win-win for both both countries if China is willing to do what it needs to do. Unfortunately, the Chinese economy is slowing quite a bit. Property market is slumping. Employment is down. So, in order for domestic consumption to really rebound, all that has to sort of stabilize, and we haven't seen that yet.
Well, at least relief for now. We'll see where the next 3 months bring us. Brendan, Alan, thank you so much. Brendan Murray and Alan Wan on the latest trade talks out of Geneva. Let's get you now some other top stories that are trending on the terminal this morning. President Trump said that he plans to order a cut in U.S. prescription drug costs by mandating that Americans pay no more than the people in countries that have the lowest price. In a social media post, Trump said that he'll sign an executive order at 9 a.m. today that he claims could drop pharma prices by 30% to 80% in the U.S. Elsewhere, the Trump administration is likely to accept a luxury Boeing 747-8 jumbo jet from Qatar's royal family. That, according to ABC News, the aircraft is set to be used as Air Force One, with sources saying the gift is expected to be announced this week during Trump's Middle East tour. Trump has been seeking alternatives to replace the aging Air Force One since his first term. And UniCredit posted its highest quarterly profit ever as CEO Andrea Orcel pursues potential acquisitions. His pursuit of Germany's Commerzbank has sparked a backlash in Berlin, while his unsolicited bid for Italio's Banco BPM has triggered government resistance in Rome. A quick check on markets before we head to the break. And again, we are off to the races. S&P 500 futures back to the levels that they were at March, so we're above Liberation Day levels. The Bloomberg Dollar Index maybe not as big of a relief, but it is still relief. The weakest day for the euro so far this year. You can see it's down 1%. Sterling also lower this morning. That euro at 1.11. Coming up, we're going to dive deeper into the market's impact. How much do you need to rewrite the narrative this morning? We'll catch up with Principal's Seema Shah. That's coming up next on your Bloomberg Brief.
Our reciprocal tariff rate will go down to 10% on the United States side, so it goes down 115%. We enter into a 90-day pause period for negotiations, which both the Chinese and the United States are very committed to. And the Chinese on their side also go down 115% to 10%, and they remove the countermeasures that they have in place.
That was U.S. Trade Representative Jamieson Greer on the details of the tariff deal, with China. Seema Shah of Principal Asset Management writing earlier, the economy will surely weaken in the coming months, but with this underlying momentum, the U.S. has a reasonable chance of averting recession if it can step back from the tariff brink in time. She joins us now. And Seema, I know you wrote that before this morning's deal because basically no one has had time to readjust. But I wonder, is this stepping down from the brink? How much does this morning's agreement change things for you?
Good morning, Danny. I think it has to change things. I mean, when we were doing the forecast and trying to analyze what the impact of China's tariffs could be, we were looking at a subtraction to U.S. growth of around 1.5% if you take into account the exemptions to electronics that had already been announced. So this is really meaningful, and take into perspective as well that the market was definitely not expecting anything as significant as this. I mean, I think the best I'd heard was the 60% tariff. So this is a meaningful change. Now, obviously, the market is going to try and pull through the details and try and find holes in it. But I think if it's telling us that at least the Trump administration is not going to be moving forward with tariffs at this kind of level or the level before today, I think that is definitely good news. And there's certainly going to be a positive impact for the U.S. economy and for the Chinese economy as well.
If we assume then, or do you assume, Seema, that 30% becomes the new global ceiling for tariffs given this agreement? And if it is 30%, what does the growth outlook look like?
So if we're looking at a 30% tariff for China, which is maintained, and certainly I know that there are question marks about whether we can actually see all the details finalized within a 3-month period. Well, of course, they can continue this extension, these 90 days, they can keep pushing it out. But if 30% tariff becomes the norm, and I think it's generally a good news for the U.S. economy. I mean, look, there will still be an economic slowdown because you're still pushing back on export growth. and some impact on inflation and for consumer spending as well, but significantly smaller than anyone was anticipating. And I think all the forecasts for recession that have been out there start to get pulled back in the next couple of months.
I wonder just how much of an unwind we have. I was looking earlier this morning at a Bank of America FX and rate survey that still the highest conviction view was that we were in peak U.S. exceptionalism. Does that start to unwind? Do we unwind the Sell America trade starting this morning, Seema, and how far would that unwind have to go?
Well, certainly any traders that have reduced their exposures to US equities and certainly had been sitting underweight will be feeling really uncomfortable today. I think maybe we have hit the peak, but I don't think that the discussion is going to go away entirely. I mean, importantly, for places like Europe, there have been meaningful advances with regards to talking around infrastructure spending, defense spending, and those are really going to strengthen their economies, not just for the next 2 or 3 years, but actually looking further out. So increasingly, this is going to be a discussion for investors. If you have a marginal dollar, you now have a discussion. Is this going to go to the US? Is it going to go to Europe? Is it going to go to another part of the world? I think US exceptionalism likely does stay, certainly if the news of this morning is something which is going to be sustained. But I do think the world is a bigger place, and I think it's been a really important reminder of that over the last 2 months.
Well, also on kind of the same note, Seema, you talk about the rest of the world putting investment into infrastructure. Just on the U.S. side, to what extent is there damage already done in terms of delayed spending plans, delayed hiring plans? Are there going to be scars even if we do continue to see a significant walk back of tariff rates?
I think you can expect there to be some scarring. I think that's the reason why we can still expect a weakening to come into play over the coming months, because, as you said, so many investment planning has come to a halt. And of course, we still have to see what happens to supply chains. But importantly, look, if that's just a pause and companies feel like they can see a way through, they will restart that investment spending. And importantly, the economic data has been so strong that we know that there was good momentum in the US economy before all of this hit. So that does suggest that you could get a fairly rapid recovery, of course, assuming that this 30% tariff is maintained and it doesn't just reverse back to a significantly higher level in the next 3 or 4 months.
There will be people this morning, though, Seema, that see the move higher in yields and get concerned. Concerned, to your point, that there might still be some weakening to come, but we're going to have higher yields, a tighter economy, and a Fed that feels like it can sit on its hands for longer now that we have these pause in tariff rates. Is there a risk that you do have a Fed that feels more comfortable not cutting with an economy that still might be on shaky grounds?
I think one of the key things that we're likely to see is investors, traders really pulling back on their Fed expectations for this year. As it is, because of the strength of the economic data, we've already had a number of people talking to us about no cuts at all for this year. But I think the important thing is that, look, if the US economy is on a fairly shaky ground, but at least the momentum is strong and you can see the investment spending return to the economy, it is possible that the Fed doesn't need to cut rates this year. I mean, I think that's a little bit early. We are still expecting 3 rate cuts to come September, October, December. But let's see how things pan out. But I think this is, of course, a growing discussion, and we're going to see FOMC members really talking about this over the next couple of weeks.
And again, Seema, what we're seeing this morning, very much so, just the first gut punch reaction. It often doesn't stick. You've pointed out that we're going to continue to sort through details and what actually happens after 90 days. But the gut punch reaction, you can see it there. It is tech outperformance. Dan Ives of Wedbush, a tech bull, writing this morning about how consequential this change is, that it's a huge win for the bulls and the best case scenario for tech. Do you think that that aspect of the reaction that we're seeing sticks, that tech comes back as the market leader?
Well, it's been interesting because actually, increasingly, even over the last couple of weeks, we've heard more and more people showing some growing interest in technology, this belief that there's already been such a re-rating in valuations that actually, if you still believe in the long-term story, it was a time to get back into tech, and today's news is only going to reinforce that narrative. And of course, if you do see technology return as that front runner, then you are looking at pretty significant gains potentially for the S&P 500. I want to make sure that, look, of course, we're bullish and this is really good news. There will be some potential for pullback as you see maybe headlines over the next 3 months or so. So it's really important for investors to try and look through that noise. I think the biggest takeaway today is really, look, the Trump administration doesn't have any intention of keeping tariffs at these very, very high levels that we've had for the last month or so. And so most of the worst of the recession concerns are probably somewhat unfounded.
Seema, I think that's the perfect note to leave it on. Thank you so much for joining us this morning. Brilliant as always, Seema Shah of Principal Asset Management. And to that point, we are walking away from a lot of the haven currencies this morning. Yen and Swiss franc weakening versus the dollar, but everywhere else it is a story of dollar strength. The euro falling just about 1% versus the dollar for its worst day of this year. You're watching Bloomberg. Welcome back to Bloomberg Brief on a day of relief for markets. I'm Danny Berger in New York. Let's get you some front page news, a look at what's making headlines, and pour one out for the front page editors this morning who have had to quickly re-scramble to adjust because this is on the front page of basically every major paper, the trade deal. The announcement, it is a step towards de-escalating a tariff war. The two countries had earlier reported substantial progress in their talks. It's buoyed markets. It's helped Chinese stocks recoup their losses since President Trump's so-called Liberation Day announcement on April 2nd. So markets greeted the report with progress, but history does suggest that it could take a long time to reach a detailed agreement if one is possible. In 2018, recall, the two sides also agreed to put their dispute on hold after a round of negotiations, but the U.S. soon backed away from that deal. That could be, as history, very instructful for where we go from here. Capital Economics also writing this morning, pouring cold water over the deal, saying that the tariff rates still remain high. The U.S. still looks like it's pushing partners to back away from trade with China, and that there's no guarantee that the 90-day truths will give way to a lasting ceasefire. Markets trading it as such. We are looking at commodities moving much higher this morning, along with risk assets. We'll have more coming up on your Bloomberg Brief. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. And we have a deal. The U.S. and China shake hands.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels.
And the ensuing rush to risk, stock futures and the dollar jump, Treasuries and gold tumble. But drug makers, they take a hit after President Trump readies an executive order to cut drug prices in America. So it's major de-escalation, 30% tariff rate for China, 10% for the U.S., and the Sell America narrative unwinds. NASDAQ futures and Russell 2000 outperform, both up about 3.8%. Your S&P 500 future session up about 2.8%. We are back at the March highs. You also see some relief in the dollar. The euro off the lows of the session, but still weaker by just about 1%. We are still headed for the worst day of the year for the euro so far this year. Treasury markets, we also see selling there. Yields move higher, especially on the front end. As we move to price out Fed cuts, we only have about 60 basis points now priced in for the totality of this year. That's back from 125 at one point after April 2nd. So your 2-year yield right below 4%, your 10-year yield at 4.42. Let's get some stocks moving underneath the surface. A lot to keep track of. Here with that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So one of the few areas of the equity market we're seeing weakness is in pharmaceuticals as Trump looks to rein in prices for drugs in the US, potentially going to introduce a lowest prices abroad method where they try and lower the prices in line with some of the cheapest countries. So we're seeing Novo, Pfizer, Bristol Myers, Merck all dropping in the pre-market today. But as I said, most of the sectors are green. Take a look at the Mag 7. Elon Musk will be feeling a little bit better this morning with this gain we're seeing in Tesla, leading the rise there, up almost 8%. And the other peers, Amazon, Apple, Nvidia, all gaining as well. Positivity across the tech sector. And another sector standing out for me was airlines. We're seeing a bit of a rebound in those shares. Delta, you remember that one, they cut their earnings forecast due to the worries around tariffs. We're seeing that reverse today. American coming up, United coming up. It's going to be green pretty much across every sector, although that pharma sector looking weak, but pretty much green everywhere we look this morning, Danny.
Yeah, and I'm not so sure that this deal will convince Canadians that they need to come visit the U.S. Joe, thank you so much. Bloomberg's Joe Easton there. Thanks for your work this morning. Let's get back to that top story because tensions are easing as the U.S. and China agree on a temporary pause in tariffs that each nation had opposed on the other.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%.
U.S. tariffs on Chinese imports now go down to 30%. China's levies on American goods dropped to 10%, both down from 115% from previous rates. Planned sectoral tariffs, though, those remain unaffected. Joining us now is Bloomberg's Brendan Murray, who leads our global trade coverage. So, Brendan, what did we get out of the meetings over this weekend?
Yeah, so we didn't get a trade deal out of these meetings over the weekend in Geneva. What we got is essentially a ceasefire or a much needed ratcheting down of the tariff pressure that was hurting both economies. I think what we're going to see going forward over this 90-day period is some uncertainty about what exactly the goals are to negotiate an agreement going forward. The longer term arrangement that the U.S. wants to do with China to rebalance the out of balance trade situation. So we're going to see the Chinese will probably be very happy with this deal. The tariffs that they're now facing from the U.S. are much lower. They in turn lowered their tariffs on American exports, but of course that's a much smaller number than the number of U.S. imports from China. So Beijing got a pretty good deal out of this, some of the analysts are telling us, and we'll have to wait and see what President Trump thinks of it when he wakes up. But it seems like that we have a 90-day ceasefire basically, and a lot of issues to work out in a fairly short period of time when it comes to the amount of time it takes trade agreements to be worked out.
Brendan, your point on Trump, I think, is well taken. I think there'll be a lot of folks looking and staring at their screens on Truth Social to see if the president puts out anything that could shake this up. But in the meantime, Ryan Peterson of Flexport tweeting immediately after, "Get ready for a shipping boom." Brendan, how much does this change things for global manufacturers that have been facing essentially a trade embargo between the two nations?
Yeah, exactly. We've been seeing the numbers of ships coming from China to the U.S. West Coast drop dramatically over the past few weeks with this effectively a trade embargo in place. What we're going to see now is a race to get those Chinese goods to the U.S. and all of that shipping capacity that's gone idle is going to get revved up again, and those goods are going to start pouring back into the U.S. to beat that 90-day deadline when the tariffs could snap back up to those higher levels that the U.S. has now suspended. So I think what Ryan Peterson is talking about is there's a window here for American importers to move if they can move quickly, and for Chinese exporters, it will give them the outlet to produce the goods that they're producing and get them to the markets where their biggest customer is.
Brendan, thank you so much for your coverage on what is already a very busy morning. Brendan Murray. And it is only 5:30 a.m. here in New York, and so much feels like it has changed. Joining us now is Amanda Lynam, head of macro credit research at BlackRock. Amanda, great to see you. Thank you for joining. Has a lot changed for you this morning?
Thank you for having me. Good morning. I would say from a step back, we have been comfortable selectively moving down in credit quality within credit. So I think that gives us further confidence in that move. I think this is unquestionably positive, directionally at least, for sentiment. I think the key will be twofold. One, do we have similar agreements across the board with a range of other countries? And then two, what does this mean for dispersion in the credit markets? Certainly, we've seen certain sectors that will be impacted by tariffs. So I think those two themes of further supporting the valuation and credit, kind of seeing the follow through, and then also kind of what sectors are impacted in either less or more negative ways. That will be really key for credit investors to monitor.
Well, you even saw Scott Bessent saying that we still want to do a restructuring, that there's certain sectors that we basically want to proof ourselves that we don't go through COVID again and we can't source things. So when you look at this sort of rally, do you not fully participate in it then? Because you want to await those details.
I think the areas, it's a great question. The areas where we are, I would say, more hesitant to fully step in are that kind of the so-called left tail parts of the credit market that were already under pressure before we saw any sort of deterioration in the hard data. Because even with this positive development, relative to the counterfactual, we're still expecting a more challenging growth inflation mix. We still have some tariffs relative to the previous baseline. So there is going to be a headwind in certain parts of the economy. Where we would be most hesitant are the parts that were already under fundamental pressure before we start to see that come through. You had mentioned the kind of the shipping data. I think we're expecting for some ongoing distortions in the economic data, so it will be hard to see that come through. A company level commentary will be really important in this regard. But I think that's really where we would have some pause, is kind of those sectors that were already under fundamental pressure that will just maybe be further exacerbated, albeit not to the extent that maybe before this news. Yeah.
I mean, your point on the data distortion is very well taken. It feels like we haven't gotten a clean read on data in quite some time. What does this do for a Fed? Is this a Fed that needs to continue to sit on its hands then?
So we think that the Fed's reaction function is more constrained. They've been talking about the potential for tension in their dual mandate. I think absent really a sharp deterioration in the hard data, they're not going to be cutting preemptively. We've had a view that cuts in the first half of 2025 are unlikely. We're still confident in that view. But I think actually today's announcements, to the extent that it removes that kind of left tail risk of a spike in unemployment, really the Fed can wait and see, which is what it's really been signaling even as recently as the press conference last week.
Does that worry you at all? Yes, we had a major de-escalation, but we still have to figure out what happens after 90 days. You still have a lot of companies that have pulled back on their spending and their hiring plans. Are there scars that still mean that this is a Fed that should be adopting something that looks more accommodative?
I think there's an overhang of uncertainty, but really our conversations with investors and market participants over the past few weeks have really emphasized that time is of the essence here. So I do think it's positive that there's some momentum in these conversations. I think the other thing is we've been really sensing a proactive approach to navigating this. We're not sensing that there's kind of a risk-off posture or retreating. I would say, on the contrary, it's a bit more front-footed. So I think corporates and investors alike will want to navigate this to the extent that they can in a more proactive way. That's what we'll be watching for. Again, that company level commentary, just like during the pandemic, was really insightful. We're expecting it to be really insightful this time around as well.
I mean, you're seeing just this remarkable rally this morning. Is this a market that is primed to rally because of positioning, or is it something that had already been priced in? Because I think there was an assumption over the weekend that talking itself would be good and you can buy equities because of that.
For sure. I will say, at least on the credit side, there was a recognition of the what could go right risks. So I would expect credit spreads, all things considered, to end the day much tighter, or at least meaningfully tighter from here. But I would say there was a recognition from credit investors that we couldn't be too defensive, given that there were some potential for positive upside risk. That's, again, why we were selectively comfortable moving down in quality to a certain extent. And I also think the positioning of investors, if 2024 taught us anything, it was that there was an opportunity cost to being too defensive. So I think that has been looming large to a certain extent, but for sure, risk assets, as you can see in the pre-market in equities, are responding to this.
Well, much like shippers who want to get out ahead of these 90 days, what about issuance? I mean, are we going to be off to the races and companies now saying, now is our window if we want to get debt out into the market?
I think so. May is historically an active seasonal month anyway, as companies come out of earnings-related blackouts. I do believe that will be a top-of-mind consideration, not just because of the improvement in financial conditions, but also I think corporates, even this is a lesson that started after the financial crisis, see the value in issuing when they can, not when they have to. And they have been historically issuing multiple years in advance. That's true in investment grade and high yield. I think that's a prudent step for CFO and treasurers, and I think we will see that as well.
For the C-suite, though, we just came out of the busiest week of earnings season. We got all these various figures. It's a $5 billion hit for Apple, $5.5 billion for NVIDIA. Do you expect to see corporates update this market? Is that what investors need at this point? Because again, it is a fast-changing situation. 100+ tariffs on China is very different than 30% in terms of how it'll affect these companies.
I think to the extent that they can provide clarity, and maybe that will be a scenario analysis, maybe that will be sensitivity analysis. I think corporates will try to do that. It's very dynamic. It's very fast-moving. I think really what we've been emphasizing is kind of this back-to-basics fundamental credit approach. What are the companies that we feel have the confidence to navigate through this? Management teams, product diversification. That will, I think, be first and foremost for investors to watch over the next few months.
Amanda, it is so wonderful to get your take this morning. I know it is a lot to adjust to. No one else we'd want to discuss it with besides you, Amanda Lynam of BlackRock. And a quick check on markets this morning. As we do reprice, we unwind some of that Sell America trade. S&P 500 futures now at the highest level since March. You're also looking at the dollar backing off some of the losses, not as maybe enthused as we see for those risk markets. Your 10-year yield, that is up 4.7 basis points at 4.42. Coming up, one part of the market still under pressure. Shares of drug makers fall. President Trump plans to slash prescription prices. We're going to discuss that next on your Bloomberg Brief. This is Bloomberg Brief. I'm Danny Berger in New York. Drug makers firmly in the red this morning as the rest of the stock market jumps pre-market. Novo Nordisk down as much as 4%. President Trump said that he plans to order a cut in U.S. prescription drug costs. He wrote on Truth Social that the U.S. will pay the same price as the nation that pays the lowest price anywhere in the world, and costs will be reduced almost immediately by 30 to 80%. Joining us now is Sam Fazeli of Bloomberg Intelligence. Sam, we have to start with the price action this morning. We were talking about this in the break. A double whammy for Pharma because you have positive risk assets everywhere else, and this truth from President Trump.
Yeah, so Danny, we've got the sector's got a little bit of a problem today in that people are risk on, so the defensive character quality of the sector is not necessarily in play anymore. You don't need that. And at the same time, you've got this news that threatens the pricing power that they have in the U.S. So not a good day for pharma in general.
So on the announcement itself, on this executive order that we're expecting at 9 a.m. Eastern, lowering prices around 30 to 80%, matching the prices of the lowest nation. Sam, do we have any idea of how that would actually work?
No. Honestly, no. I mean, number one, you can't price against the lowest nation. Where is that? If Ethiopia, is that which country has the lowest price? There is a reason they have the lowest price. They can't afford it. You're not going to surely price it to the lowest number out there, because the reason it's there is because those countries have got no ability to pay for drugs. So what are you saying here? Is it better for pharma companies to stop selling drugs in countries where access to medicine is really tough? I mean, that doesn't make any sense. So it has to be the measure has to be against countries that have got at least similar GDP levels, or although nobody else does, versus the US, that you can make some comparisons there. Europe, Canada, those are the places where I would suggest you look at if you were going to do this.
So, Sam, what becomes the impact? Maybe it doesn't go to 80% reduction, but we get some sort of reduction. What areas of pharma, of medicine, become the most impacted by this move?
Yeah, so the most easiest area to go after, which is what the IRA did, is the Medicare negotiating powers. How quickly they can implement that, how much more work that needs. Is it all existing drugs, or is it going to be new drugs? How is that going to come out? I don't know, but we do know that negotiating prices for Medicare and then setting them lower will have an impact. Pharma companies have been able to absorb that now. But if that ends up being a much bigger price cut, then that's a bigger issue. If you go to Medicaid, then we do know which companies are impacted by Medicaid most. You know, the two different government-funded programs in the U.S. The issue there is whether it bleeds into what's called the 340B program. The 340B program is what basically a lot of hospital drugs, which include oncology drugs, are included in. And that negotiation is really, really important here, because oncology is one area where we're seeing amazing progress in terms of extended survival, etc. So you don't really want to be taking the rug away from under the feet of that innovation.
Sam, thank you so much for joining us this morning, trying to work through what that could actually look like, a difficult task. Sam Fazeli of Bloomberg Intelligence. Let's push ahead now to the rest of the week, because President Trump is set for the first foreign visit of his second term. The president will visit Saudi Arabia, Qatar, and the UAE. That starts tomorrow. Axios reporting that the president is seeking $1 trillion in deals during this trip. For more, let's go to Bloomberg's Jomana Bercecci in Dubai. Jomana, great to see you this morning. What are we expecting from the president in the Middle East?
Yeah, so I'm here in Riyadh, and we're going to be covering for Bloomberg Television for the rest of this week. It is a really significant visit, and not least because it is Trump's first major overseas visit. He's going to be landing in Saudi Arabia tomorrow morning. After that, we'll be continuing his trip to Qatar and then later on to UAE. But as you were saying, the focus of this trip seems to be around business and deal making, and perhaps less on geopolitical breakthroughs and peacemaking, is what some people are calling it. And we got some hints of that by some of the measures that were reported last week, namely that the U.S. are looking to perhaps loosen restrictions on sovereign wealth funds investing into the U.S., fast-tracking some of those investments. Expectations are high in terms of some of the headline figures. Remember, President Trump and the Crown Prince Mohammed bin Salman had a call very close to his inauguration where the Crown Prince pledged to invest $400 billion into the U.S. over the next few years, $600 billion rather, over the next 4 years. President Trump retorted that he would like to see that number revised upwards to $1 trillion. So yes, definitely there's going to be a goal on his part to get to those big headline figures. But where are we going to see the deals? We're hearing potentially on critical minerals, on a defense deal. There was reports of perhaps a $100 billion weapons and arms deal that's going to be signed between Saudi and the U.S. Artificial intelligence. We know that Saudi Arabia and UAE have been pushing for looser restrictions in terms of the chips that they can get access to. And then of note as well, there is a U.S. Saudi business investment forum taking place tomorrow with the likes of Larry Fink and Jane Fraser attending alongside other huge newsmakers as well. So we will be paying close attention to some of those big headline deals that will be coming through.
A lot of possibilities to come out of this, Jomana, and already the media seems to be whipped into a frenzy from an ABC report that Trump would be accepting a luxury jet from Qatar to redo Air Force One, a Boeing 747-8 jumbo jet. Jomana, what are the details we understand about this deal?
Yeah, well, President Trump actually confirmed that the discussions are taking place because he posted about it on Truth Social with the caption, "Free gift." But of course, there are major legal and ethical considerations to think about here, not least because the president cannot accept such a substantial gift. And here we're talking about the value of a plane that's around $400 million worth as a gift from a foreign government without congressional approval. And so the fact that he is even considering acting on this unilaterally raises some serious ethical and legal considerations, which has prompted much of the reaction that we're seeing from across the aisle within the U.S. But the Qataris media attaché to the U.S. has said that nothing has been agreed yet. It's still part of a conversation. Perhaps they're thinking of loaning it only to the U.S., but still raises questions about conflict of interest and all of the business deals that Trump organization is looking to get done over the course of the next few weeks as well.
Jomana, really looking forward to your coverage throughout the rest of the week. That is Jomana Bercecci in Riyadh. All right, back to a check on your markets this morning because we are now at the highs of the future session. S&P 500 futures up close to 3%. I should point out Russell 2000 futures up 4.3%. So a lot of that fear being priced out, even though yields are moving higher. That's usually not a trade you see happen at the same time. Yields are moving higher by nearly 6 basis points for your 10-year yield. The dollar strengthens versus most assets. Coming up, we're going to set you up for your week CPI data. Chair Powell remarks, a lot to keep track of. We'll help you do it here on your Bloomberg Brief. I'm sorry, but you still have a full week to get through. So much news, and it's not even 6 a.m. here in New York, but let's get you set up for that week. President Trump will be heading to the Middle East, visiting Saudi Arabia, Qatar, and the UAE. We'll also get the latest read on U.S. inflation. CPI comes tomorrow. Plus, Fed Chair Jerome Powell will be delivering remarks on Thursday. And now to that news this morning, a major de-escalation. Tariffs move to 30% for the U.S. on China, 10% the other way around. Look at what equity markets are doing. We are off to the races for Russell 2000 futures, vastly outperforming, up about 4 1/3%. For your S&P 500 futures session, we are up just under 3%. We're now at the highest level since March. Your bond market 10-year yields, those are at the highest since 1 month as well, too. A major repricing. Surveillance will carry the details forward for you. This has been your Bloomberg Brief.